I'd like to provide you with a first quarter market update. And at North Texas Wealth Management, we look at elements to help drive and stay market driven when we execute market changes. And so as we look at those elements of, trend, obviously positive, financial or economic health is extremely strong. And then the valuations, are starting to look a little bit more expensive, but volatility is relatively low. And so as we look at investing in the market, things seem pretty great. But I want to bring on a global strategist, and we're going to answer, really those tough questions. So as the S&P 500 becomes a little bit more top heavy with the largest 7 firms, should we be concerned? Artificial intelligence, is it, something we should be excited about, or is it overdone? And then, of course, overall Fed policy, interest rates driving the market. What do those trend lines look like, and what should we be doing to help insulate the portfolio? So let me bring on our special guest, and we can get to the bottom of it. Hi, welcome back to another episode of the Values Exchange podcast. I'm excited about our guest today to talk about everything from current market trends to artificial intelligence and what it means to the market. Stephanie Aliaga is here with me, global market strategist for JP Morgan Asset Management, market insights team, and it's based out of New York. Stephanie, thanks for being with me.
Yeah, thanks for having me.
Yeah, so Stephanie, I got to tell you, we've seen you on Bloomberg and Wall Street Journal. You formulate, communication, economic views. Found your interviews on artificial intelligence really intriguing, and so I appreciate you taking the time to be with us. I was looking at your background; it's really impressive. So, Guide to the Markets is a publication that's updated daily by JP Morgan. I think really a lot of advisors, if not all advisors, really kind of lean on that research material. It's absolutely just invaluable when we're trying to understand the market. But, also you graduated from Wharton, really impressive background. And so, really appreciate you taking the time to help educate our clients and kind of bring to light, what's going on in current markets. Kind of the big picture, when we look at current market trends, kind of where we are, there's 4 factors that we really pay attention to. So, we look at volatility, and volatility being pretty low, it kind of signals kind of safety in the market that, hey, things are kind of, calm and maybe a good time to get in. But we can't ignore the fact that, the headlines out there of, hey, the market is at an all-time high. We look at valuations, we look at one standard deviation statistically away from what we would see as the average. And so the question that I think investors are asking is the stock market, the S&P 500 starting to look overpriced? What's your thoughts on that?
Yeah, that's the big question, right? I think this year relative to last year, the fundamentals just look so much better than they were last year. Now that has helped provide this powerful wind beneath the sails of, or behind the sails of the markets. It hasn't just been the AI names this year. It's also been a bit of a recovery outside of the index. But I think that AI narrative has just been so powerful, and combine that with a decent economy, a pretty strong economy, I'd say, actually. And it's been this powerful antidote that's just allowed some really stellar market performance. Now, I will say, this is on the backs of a really hard year in the markets of 2022. You had a lot of those tech names have massive sell-offs. And so some of the performance last year was really just kind of getting back to where they were before. But a lot of the growth, I think, that we've seen in the markets this year relative to maybe 2021 or 2022, like that kind of tech boom, is that so much of it is earnings driven. It's the fundamentals that look so good. And even in those top tech names that have had the strongest performance in terms of their stock prices, their valuations actually don't look all that overstretched relative to their own history. And if you base those valuations on their long run earnings potential, they also don't look that overstretched. So this market is not, I think, anything to me like the dot-com era. We're not seeing that same kind of exuberance and money chasing small cap names that just attach to AI to the end of their ticker or whatever that means. There might be some of that, some excitement around potentially the race, I think, when it comes to AI adoption. But a lot of the money has been chasing some really high quality names that have just continued to deliver in terms of earnings. And if that can continue to happen, then there's really no sense of urgency to kind of not to rebalance, but to get out of the markets and to protect yourself from fraud.
Right. So when you start thinking about investors and strategies, if we start looking at PE ratios and they look expensive, you're saying it's not really time to jump out of the market or reallocate to something more extreme. What are some of the strategies that you're seeing implemented based on these valuations?
Yeah, so I'd say on the one hand, you want to make sure that you're actively rebalancing portfolios. If you haven't adjusted any of your exposure to large cap growth in the last 15 months, chances are you're left with a lot more of it than you started with because of how much performance has already happened. So, every investor has their own unique risk preferences. I think even though I do believe that AI is still in its early innings of an investable cycle that will last many years. There has also been a lot of performance that's already kind of occurred with pricing in a lot of that potential, a lot of the growth in those names. And those tech names are also not immune to market sell-offs, right? I think 2022 is a prime example of that. And so you want to make sure that you're rebalancing where appropriate. You want access to the high quality tech names that are going to potentially be the leaders in AI adoption in this super cycle over the next 10 years. And in that exposure, you probably want to be active as well because the market leaders in AI and technology tend to change a good deal, particularly when we have these kind of paradigm shifts. And we have a great actually chart on this in one of our white papers that illustrates just the top 10 names in each kind of technological paradigm and how much of that has changed decade over decade. So you want to make sure you're not taking the Magnificent Seven as given, right? Because I think even year to date, you've already seen that two of them have fallen out of favor. Maybe it's the Fab Five, like whatever you want to call it. Those names are high quality, but who's to say that they're going to continue to dominate to the degree that they are right now over the next 10 years? So you want to make sure you're having those conversations in terms of risk exposure. And then outside of the markets, where last year the Mag 7 really was just the only game in town in terms of earnings growth in the markets and in all overall stock appreciation. This year, we're seeing that broadening out begin to happen. So you've actually had value perform a bit better. I think, there's this realization that if the economy's, the Fed's going to achieve a soft landing, then a lot of the perhaps riskier areas or more cyclical areas of the markets can actually do a bit better. So we're seeing that performance begin to broaden out. And I think for investors that are looking for differentiated ways to gain exposure to risk assets, like it's still, I think, a ripe land for some of those opportunities.
Yeah, I'm glad you brought that up. I think that's a key component we've been watching is the Magnificent Seven, or the S&P 500, basically getting very top heavy with just the top 5 to 7 firms. What are some strategies there that you're recommending or seeing as a trend?
So I think it's all about diversification. That is, and I think you want to be intentional about which trends and where you're finding, where you're allocating, where you're spending your risk budget, right? So you want to spend your risk budget with those names that are likely going to be the leaders in this technological super cycle over the next 10 years. And with that, I'm a fan of a lot of the US tech. Now, outside of that, you also want to make sure that you're not overly exposed to those names for your own risk appetite. And in terms of strategies, I think we've seen more emphasis on value, on cyclicals, like I mentioned. I think other ways to play some of that tech secular growth exposure in areas like healthcare or some of these other industries that are going to be massive beneficiaries to AI and greater technological adoption. But then also, chances are, like, you're very, very underweight the rest of the world as well. And I think another surprising thing to note this year is that not all of the top companies in the global markets have been in the US. European, uh, the European markets also have their share of companies that have done really well over the last year. And have actually, some of those indices have actually kept track with US growth exposure. We have a slide in our guide to the markets that's called Secular International Trends, which actually shows that if you look at some parts of the European market, so if you take Europe biotech, or you take Asia technology outside of China. And if you take some of these just broader, like European luxury goods, which is actually a play on the global consumer, those sleeves of international markets have kept pace with US growth, which has been the belle of the ball of performance over the last 10 years. And they're trading at more favorable valuations relative to US companies, some of them. So I think internationally, there's some really interesting stock stories, like stock specific stories, but also just other ways that you can kind of differentiate the exposure that you're getting in terms of some of these exciting technological trends, but not keeping all of your eggs in one basket when thinking about those magnificent companies dominating the S&P 500.
Yeah, I think I agree. And as we look at the trends of AI, and I looked at that research and the interview you had with Dr. David Kelly, and I wanted to kind of focus a little bit on some of those key questions. So, and I think that's the question that we're all wondering. Is AI really a game changer, or is it just all overdone and we're waiting for the bottom to fall out of the market, right? So what are you looking at that, I think obviously I feel like you think that the market is going to do well with AI and it's a game changer. What makes you think that?
Yeah, it's it's a really important question. And I think when we started on our own research path of trying to decide and estimate the impact that AI could have on the overall economy, that was the key question. Because productivity and TFP, which is really like the kind of productivity that's a reflection of technological improvement, has been really stagnant over the last 10 years. And we have had all sorts of innovations populate our day-to-day lives in that time, right? Productivity growth has averaged just 1.2% over the last 10 years. And what I think we realized with AI was that, one, it's not that all of the sudden AI is this new technology. It has been growing over the last, like, these technologies have been in development for many years. I think last year was almost this iPhone moment, or actually, I think maybe what's more apt is like the invention of the microprocessor, which in the 1970s, that was really the invention that allowed, there was this significant milestone in allowing the widespread adoption for computers, because it made it so much cheaper to produce. And when it was cheaper to produce, then suddenly it was much more accessible, and demand really picked up. And now suddenly everyone was able to use a computer, and that led to all sorts of innovations. I think similarly, generative AI and large language models have really proven and kind of opened Pandora's box to the sophistication of this technology that has been in development over the last many, many years. But now that it's ease of use for the masses. And it's been kind of this tipping point that now we're seeing adoption is kicking up at a speed that we have not seen in modern history. But granted, does follow this trend that we've seen of just adoption taking place a lot faster for newer technologies relative to past technologies. But specifically to generative AI, its ability to automate so much of what we do, because of its ability to kind of access that other level of thinking when it comes to machine learning, but not just machine learning, but also its ability to do so in so many different domains, to leverage insights from audio, visual, text input, to analyze patterns in all sorts of differentiated, dispersed, and unstructured data, which is like the formal term for it, and to deliver completely new content from that. I mean, that ability has never been packaged before in a way that is actually quite easy to use for your everyday worker. You actually can speak to an AI machine just like you would a colleague. We spend an estimated 25% of our days at work just communicating with one another. So being able to communicate with a machine just as easy as you would a colleague opens the door to collaborating with them, to leaning on them for all sorts of work that we spend our day to day on. I think many of us have probably played with ChatGPT at this point, right? The kinds of things that it can do are pretty impressive, and I think we're only beginning to scratch the surface on that. But even if you just take some of those mundane or actually more routine tasks that you can just give to ChatGPT, if you add that up across the entire economy, some of those summarizing texts, synthesizing, like reading a huge academic paper and delivering your kind of 7 key takeaways, that takes a lot of time. And that kind of task is something that a lot of workers do in all different corners of the economy. So what we did in our research was we added up, like, okay, let's just say we take some of those tasks that are not actually all that exciting in terms of what AI could potentially really do, but we add that up across the economy, and the direct impact to productivity from automation was really material. And even when we took the most conservative estimates about how sophisticated AI was going to be, we were still getting at about a 1.4 to 2.7% increase in labor productivity every year over the next 10 years. And when we surveyed the academic research, I'd say estimates are within that ball range. Some are actually on the much higher end, some are a tiny bit more conservative. But if that's the case, I mean, that kind of productivity boost will be really material for overall economic growth, earnings growth expectations. There's a lot of uncertainty in that figure, and there's a lot of things that could potentially slow this thing down. But if we take, that longer term perspective, when we think that AI could potentially automate all those tasks, we're looking at something that could be a real productivity game changer.
Yeah, and we kind of measure that. So when you say that type of productivity improvement and impact to the economy, how do we kind of gauge the size of that? What does that mean?
Yeah, yeah, great question. So there's this cool database that the Bureau of Labor Statistics puts out, and it has all of these occupations in the US economy. It tries to like represent all the occupations in the US economy. And then through all these like surveys, through census work and business surveys, they actually standardize the tasks that are included in each of those occupations. And so what we were able to do was just take a screen of all of those tasks and take a chunk of what could be automated versus what could not be. And we're not the only ones that have done this. We actually we did our own work, but we mirrored a lot of what other academia has done. And funny enough, this approach is something that OpenAI did itself. It basically gave ChatGPT this database and was like, ChatGPT, what could you automate versus not? And then it had AI aggregate that across the entire economy. And then OpenAI found that ChatGPT or AI could potentially automate 60% of the tasks in the workplace. So they had their own kind of approach to it. Our approach came into I'm sorry, not 60% automated. That's the key thing. 60% that are exposed to some degree of automation. And that is really key here, because that 60% does not mean that you're going to just automate 60% of the workforce. That's not how this technology has an impact on a day-to-day. What it's going to do, it's going to automate things on an individual task level. And for jobs that have a lot of tasks that are exposed to automation, those tasks could potentially be exposed to being, automated fully. But most tasks are actually in the sweet spot of having 15 to 20 to 30% of the tasks that make up their day potentially exposed to automation, benefited from automation, perhaps, and they're able to redistribute their workdays, their labor, to work on other tasks, higher complexity tasks, to streamline, to perhaps spend more of their time on other areas of the business that are now booming in demand because of this kind of AI generated economic boom. So I think that's kind of where we see that landing on the overall economic picture. But the magnitude of tasks that could potentially be subject to automation is quite large. I'd say like 20 to 40%, in a lot of the desk jobs in particular. But what gives me optimism is, honestly, there's been a number of studies already of what what workers experience once they start integrating these tools into their day-to-day. So for example, if you take, there's this study that looks at software engineers that started using Microsoft Copilot, which is this really handy tool, AI enhanced tool to help software engineers just write and generate code a lot faster. And those engineers reported that they were actually happier at work with using the new tool because they, were able to go faster, and they were able to spend more of their time on higher complex tasks and projects, on, more critical thinking, on thinking about that next project, on collaborating with coworkers or whatever it may be. On those initiatives. So I think it's going to redistribute labor, similar as all other forms of technology have done. But if it is this rising tide that lifts all boats, sorry, history has shown that productivity enhanced growth has led to the birth of all sorts of occupations and industries, the web page designers and the computer engineers of tomorrow that we can only begin to really imagine.
Yeah, so you think AI is rocket fuel? I mean, it's gonna be what it takes to really send productivity higher and ultimately earnings higher.
Yes, over the long term,
Okay.
but I do think, I guess, that our paper, we took a 10 to 15 year horizon. Over a
Okay.
10 to 15 year horizon, we can say a lot of these things with a decent amount of confidence. Like, it's still very early innings, and we're going to have to see what actually happens once you give workers these tools.
Hmm.
And there's obviously going to be surprises along the way. I think similarly at the beginning of the iPhone, there was all of this excitement about how the iPhone was going to lead to this productivity boom, which really didn't happen all that much. Like, the internet did, but not the iPhone in particular. Maybe it accelerated, it was part of that story. But the iPhone also led to all sorts of maybe detractors to productivity. I mean, how much screen time, right? I get that notification on my phone every week, and I'm like, oh man, yeah, I spent way too much time scrolling through whatever it may be today, and that detracts from productivity. So there's all sorts of unforeseen ways that this thing is going to impact our day-to-days. I think, on the one hand, it could lead to information overload. One interesting example was that AI is going to have this huge impact on legal services, right? Maybe it makes it so much easier to sue someone that everyone suddenly is just suing whoever pisses them off on that week or whatever it may be, and then the courts are completely overloaded. So there's examples that, and now it suddenly is like so much easier to write essays or write books that like everyone's going to be this amazing author. So there's a reason for healthy skepticism. I think also in terms of the market reaction to this, there's a reason for healthy skepticism. I think markets in general have this tendency to overappreciate the near-term implications and underappreciate the long-term implications. We're in the early stages, and this is going to be a theme that remains investable for the long haul. But it could be the case that adoption has some speedboats along the way, and that there are some things that kind of pour some cold water on this. I think that is very, likely. Nvidia was one example that's just continued and continued to surprise expectations, but how long can that last? I don't know. And at some point, there is going to be, and there already are attempts at, more competition in the landscape. And there's a lot of really hard questions that regulators are going to have to figure out, that governments are going to have to address, that is really going to dominate a lot of the conversation over the coming months and coming years. And we're seeing the early innings of that, but there is like a lot really that needs to be done, a lot of hard questions that need to be asked and answered. And in the US, like, we really have not done anything on that front. Global governments also really haven't in terms of regulating AI. And that has been to our advantage in some ways because it's allowed technology to advance to the degree that it has already. But we're now seeing, I think, this greater focus, and there will be this social pressure too once this, technology leads to disruption in some areas of the economy or the workforce. There's going to be a lot more pressure on policymakers to put some guardrails around this thing, and that right now is not really being priced in the markets because it's too soon to know what that's going to look like.
Yeah, thank you. No, I think that's great insight and the balance there. And you brought up the government, and talk to me a little bit about what you see as far as the Fed's stance on interest rates, those trends, and the impact economically.
Yeah, so I think in terms of when we think about how strong market performance has been year to date, it hasn't just been that AI story, which I think really dominated the market performance last year. This year, it's been broader recovery in the stock markets, and that has been, I think, at the hands of this pivot that we've seen from the Fed. And so, thinking about the overall macro picture, right, we've had this real roller coaster when it comes to inflation over the last couple of years, and this roller coaster last year with a really swift, perhaps aggressive pace of monetary tightening to combat inflation. And we're finally at the tail end of that. And where we are at the end of hiking, and now we're looking at policy easing. And that is a really important shift because, on the one hand, I think interest rate volatility has been really crummy for bond markets over the last year or 2 years. It's also been very destabilizing, I think, for putting money to work outside of those tech names that have a ton of cash on their balance sheets, right? And now we're seeing a recovery in other more interest rate sensitive areas of the markets that were really clobbered, but now that we're looking at policy easing, may actually fare a bit better than previously feared. But also, we have this environment of the Fed beginning to dial back on the tightness, but not because growth is deteriorating. And the past few policy easing cycles have been emergency responses to recessions, to pandemic, to global financial crisis. Now we have actually the Fed being able to slowly dial back easing in a way that doesn't destabilize the markets or the economy and provides further confidence or is really emblematic of their confidence that inflation is coming down. And inflation is coming down. There is this reduced sensitivity to any delay in the pace of disinflation that we've heard from the Fed, particularly last week. So last week, markets were kind of pricing in the potential for one less rate cut this year because we had some slightly hotter than expected CPI prints. And what we're hearing from the Fed now is that actually they're pretty comfortable and confident in the pace of disinflation. And it's okay if there's some bumpiness along the road. It's okay if it takes a little bit longer to flow through the government statistics because the overall picture of inflation right now and inflationary pressures does seem to be much more muted than it was last year. Shelter inflation has come down meaningfully. That still needs to flow through to the data. Wage inflation might settle at an elevated rate relative to history, but it's come down a lot. The Great Resignation and competing job offers and this kind of upward surge in wages, like that's a story of the past. And then you have these things that have been really dominating inflation right now, things like auto insurance, which are really driven by exogenous factors outside of the Fed's control, or are just this lagged reflection of the auto supply chain crisis that we experienced during the pandemic. And so that's going to fade this year. And when we look at the data and the Fed looks at the data, inflation is coming down to 2+%, 2 to 2.5%. And if that's the case, if that's the outlook, then the Fed has plenty of reason to begin dialing back on the policy, on their tightness that they've delivered to the markets. So that's underway. It may not be as much as markets were expecting at the beginning of this year, but that's okay because it's also a reflection of a much stronger economic backdrop than the Fed was also expecting.
Yeah, and if we were going to talk about any other market indicators, we've talked about AI, we've talked about the Fed and interest rates. What are those other market indicators that you're looking at for kind of just overall market health? And if you had kind of a message to leave us with, what would that be?
So I would say on a technical perspective, like sentiment in the markets, like risk appetite is back. I think that raises some alarm bells, but it is perhaps a good sign that it's only recently really begun to kind of flash those warning signs. I think some of those examples are like Bitcoin reaching new all-time highs and like gold for some reason reaching new all-time highs. I think some of that is in the market again, and I think it is a cause for just some caution with chasing some of the gains because it's going to be really hard to repeat the performance that we've seen over the last 15 months. But so long as there's still, I think, a lot of money to put to work in this markets, sentiment is strong, but it's strong on the back of really strong fundamentals. And so long as, corporate earnings and corporate guidance continues to be favorable, which is like what we've been hearing from corporate management teams. Now, the S&P 500 is not a monolith. Some areas of the markets are doing better than others, particularly those that are catered towards the areas of the consumer markets that have just been most resilient. So maybe like upper to middle income consumers. But so long as like overall earnings are intact and earnings continue to deliver, it's really hard to take the under on this market. And so I'd say on that front, things seem well paved. We're going to need to like definitely keep an eye on earnings to actually deliver the expectations that are pretty rosy as they are right now. And then in terms of the economy, I think where we might see some cracks is just in business appetite for investment spending or labor. And I think that would have to come on perhaps a greater slowdown in terms of consumer spending. I think interest rates settling at higher levels is still going to have this gradual effect on a higher cost of capital for businesses. Debt rolling over and needing to be refinanced at higher interest rates, like all of that is still going to have this gradual weight. But until we see things begin to really crater in terms of investment spending or labor demand, the economy can still kind of chug along here at about its 2% growth rate. It's not going to repeat the same kind of strength that we saw last year, but at 1.5 to 2%, that's still a far ways from a recession. And so both of those combined still kind of look like a favorable backdrop for risk assets. But we'll keep an eye out for any data points that really point to a stark deterioration from that trend.
Yeah. Well, I hit you with a lot, and you handled it as expected with flying colors. So appreciate you really shedding the light on all of those, key characteristics that we need to be watching. So Stephanie, thanks so much for your time and joining us. I think the key takeaways today are, to stay data-driven and stay disciplined in how you make changes in the portfolio while balancing, I would say, short-term risk with long-term opportunities. And of course, rebalancing and staying diversified are key strategies, to stay ahead of it and keep your portfolio aligned with the market opportunities. Thanks for tuning in, and we'll see you next time.